One of the biggest mistakes that I see married couples make when they're planning for retirement is not accounting for what would happen if one spouse were to pass away early. The plan might look great if both spouses live until age 85 or 90, or perhaps even age 100. But if one spouse passes away early, that surviving spouse now has one less Social Security check for the rest of their life and has to file as a single person. So this needs to be accounted for because if one spouse does pass away early, it can really have a negative impact on the probability of success of that surviving spouse's retirement plan. So I've got a sample case study here for you. Let's dive in. So we've got Jack and Jill's sample, and right now they're doing great. They've got a 94% probability of success. In other words, a 94% chance of having all the money that they'll need and want all throughout their retirement years. Now, they're both 65 years old. I'm recording this in December of 2023, and they're going to turn 66 in January of 2024. I made it. Jack, we're going to presume lives to be 90, and Jill, we're going to assume lives to be 95 in this example. I'm not going to go through all the different expenses here because it's beyond the scope of this video. But what I do want to just share with you is that as far as their income, they have Jack's Social Security, which is 2,800 if he takes it at his full retirement age. Jill's would be 2,300 if she takes hers at her full retirement age. And in addition, I also gave them $25,000 here in my sample in a bank account, and then $1 million in an IRA. So I just made this Jack's IRA. All right. So that's kind of their situation. Again, they're doing great. They've got a 94% probability of success. If we look at the confidence chart here, they have a very little chance of ever running out of money. I mean, maybe in their mid 90s, if in fact they live that long, based upon the probability analysis here. But, all things being equal, they look really, really good. If we look at what their withdrawal rate looks like, you can see initially their withdrawal rate's high only because the plan right now is for her to take her Social Security at 67 and for him to take it at 70. And so you'll see the withdrawal rate's higher initially, drops down when she takes hers, and then it drops down a lot when they're both taking Social Security. And the only reason that it's going up here really is because they have to start taking out their RMDs, the required minimum distributions from the IRAs. So again, they're in great shape. But the question now is, okay, what happens if they don't live till 90 or 95? What if one spouse passes away? Because remember, again, the surviving spouse is going to lose a Social Security check. You'll keep the higher of the two, but that smaller one is gone. And you have to file as a single person. And remember, by the way, when we look at the tax brackets, this is for 2024. Just as an example, if your taxable income is $90,000 and you're married filing jointly, you're in the 12% tax bracket still. But if you're single and your taxable income is $90,000, well, you're well into that 22% tax bracket. Okay, so it's definitely quite a difference there, as you can see. All right, so let's come back over here. And what I'm going to do is I'm going to go ahead and pick on Jack. And I'm going to assume instead of him living till 90, I'm going to assume that he lives to be 67. So we'll keep this one on the right the same. This is that they both continue to live till 90 and 95. And Jack, if he passes away early. So let's say Jack passes at 67. You're going to see this number drop down dramatically here. Goes from 94% down to a 57% probability of success. So let's dive in and just kind of look at the taxes and also the Social Security as well, and kind of the differences there first. So let's go to cash flows, go over here. And first thing I want to take a look at is if they both continue to live a long life. So again, we're going to assume Jack lives till 90 and her until 95. If that's the case, by the time they're 70, they're getting about $74,000 of Social Security. And actually, this is the first full year. Let's look at this one at 71. This is the first full year of 12 payments of Social Security. So they're getting about $80,000 for the year, let's call it. In fact, I'll write that number down, just $80,000. And the other thing I want to point out here is that if we go over here, just kind of look at the taxes year by year, we're seeing some high years here. This is, you know, uh, pretty much for income, they have to rely just on the IRA. We're assuming here they spent that checking account money. So all that's going to be taxable at ordinary income tax rates. And then taxes drop down dramatically once the Social Security or once both Social Security checks have kicked in. So you'll see that difference right here. And you can see, on this side, this is the Social Security benefit going from about 30,000 up to 74 when both checks are coming in. So again, we'll just kind of compare over here at 2029 at age 71. They've got about $81,000 in Social Security, and their taxes are about $1,400 for the year. I'm just going to call this about $1,600. Let's just say at 72, like that next year. And by the time they have to take RMDs here, it goes up to about $7,000. Again, the required minimum distributions out of the IRA. So it goes up to about $7,000. Now, what I want to show you is if Jack does pass away, what happens here is that first off, let's just look at the Social Security benefit at 71. Now she's only getting 41,000 from Social Security, and where before we were assuming $80,000. Okay, so about half of that is now gone. It's a huge difference right there. And when we look at the taxes on this side, look at this. We're talking $14,000, $15,000 here in taxes. So considerably higher at this point because obviously she's got to withdraw a lot more from the IRA in order to meet those living expenses. Now, the next thing I haven't mentioned here that's really important is even in that 57% number, that 57% probability of success that we're assuming that she's going to have going forward after Jack passes away at 67, I'm also assuming that her living expenses are going to decline. Now, her health care would stay the same. His is gone now, obviously. But the living expenses here is going to drop, I'm assuming, by 15% when he passes away. Now, everybody's situation is different. It depends on what those expenses are. But, just generally speaking, there's one less car, less food, right? So things like that. So we're assuming 15% less in living expenses. That's why you'll see that drop. Now, over time, these numbers are increasing. That's because we're factoring in presumed inflation, which I'm assuming here is 2.5%. Okay. So let's go back now over to here. And let's look at our analysis. So again, we're at a 57% probability of success. So, not too good. So what things could she do just from an expense standpoint? Could she reduce her expenses even more so perhaps? Well, maybe, but let's say that right now she can't reduce her expenses, more than 15% or, in a couple years when I'm assuming Jack passes. But let's say that she's willing to reduce and can reduce her expenses. Let's say at age 75, she could reduce it by 10%. And then at age 85, maybe she could reduce it by another 10%. Generally speaking, I do find that people spend less money the older they get. So if that could work out for her, let's take a look at what the difference would be. So we went up from a 57% up to 78%. But of course, again, she'd have to make that commitment to reduce those expenses by 10% at 75 and at 85. Let me show you what that looks like here. So this is them initially. This is while they're both alive. Her expenses now after he passed just dropped by 15%. This is all in today's dollars we're looking at. We're just really focused on the retirement expense. It's the only thing that changes here. Well, everything's changing, taxes, and we've got inflation, cost of living, but this is the thing that we're reducing. And here at 85, it's going down again. So this could be one solution if she could do that, if she could reduce those expenses, perhaps that way, that would be fine. But let's say that she can't. Let's just bring this back to we're going to keep this inflation adjusted all the way. Let's assume that she can't. Now, what I want to mention here is that the earlier either one of them would pass away, The worse the situation would be for that surviving spouse, because they're going to have less Social Security, you know, that had come in, and they would have had to rely upon, the surviving spouse would have to rely upon that IRA for even more income. So let's say instead of Jack passing away at 67, let's just say he passed away at 77. And let's look what the difference would be now. You're going to see it improves a lot. Now we're up to an 83% probability of success. Okay, so he's not living till 90, but because he's living all those additional years and she's getting more of those Social Security checks, and they're filing married filing jointly for that period of time, that's helping them out tremendously here. But really the important part is these early years of retirement. And the easiest way to combat this is with life insurance. And a lot of times people don't think about life insurance, or don't think they need life insurance in retirement. It's oftentimes it's thought of as is by something that's needed by younger folks. Maybe it's a young family, the primary breadwinner gets life insurance, especially them, and if they were to pass away, then there's money that is then paid out for the family. The primary reason to buy life insurance is for income replacement, which that would be for the young family in that example. Also, too, in their case, they also may want to consider life insurance as a solution here, because it can replace income still. But in this case, it's not replacing income from working, it's replacing the salary, and just providing that additional source of tax-free money that would be available. All right, let's take a look at this. It's interesting. A lot of times I find people think life insurance is going to cost a lot more than it actually ends up costing. And especially once people get to a certain age, they just think it's going to be way too expensive. But this is a 65-year-old male, and we're just looking at a $100,000 10-year term policy. And I'm presuming what's called a standard non-tobacco rate class, which is just kind of like, you got to be like an average health in order to get that. I mean, you could have high blood pressure, high cholesterol, as long as it's under control. You could have some extra pounds on you, as an example, and still get a standard rate class. Now, each company is going to have different underwriting criteria and guidelines and things like that. But depending upon which company that you go with, for this guy, he's looking at about $80 to $90 a month. So not hugely expensive here. Now, again, we're just looking at a 10-year term policy, and there's different types of life insurance that's out there. The two basic types are term and permanent. And I'm not going to go through all that, but the key point here is that they really don't need, in my opinion, any more than just a 10-year term policy. Because remember what happened when we took a look at, if he were to pass away, I did at age 77. Well, the impact to the plan wouldn't be nearly as bad. The probability of success number, I believe, was still in the 80s. Yeah, it was 83%, right? Versus where it was about 50 something percent if he had passed away at 67. So if we just take a look at just getting a short term policy, just 10 years, again, they're looking around $80, $90 per month for him. Now, if he qualifies for a better rate class, he's in better health, it's even less than that. And for women, I also would recommend she gets a policy too, because he would be in the same type of situation if she were to pass. For women, all things being equal, life insurance costs are lower. So same health and same age and all that. The cost would be less for women. All right, so let's just see what would happen. So if he were to pass away at 67, again, we're talking a 57% probability of success. But if there was some life insurance here, so it was $100,000, let's see what happens to this number. That went up quite a bit, right? 57% up to 72%. And then also maybe she's willing to do that thing I talked about earlier by reducing living expenses by 10% at age 75, and then at 85 by another 10%. Could that help the situation out there? Now she's back up to an 88%. So we're starting to get even higher here. Now we could also consider maybe getting a little bit more coverage, maybe 150,000, maybe even a little bit more. Obviously, you need to account for this too because that's going to the premium is going to come out of those living expenses. But if in their case they need $6,200 just for their monthly living expenses, not for not for their housing costs, not for health insurance costs or health care costs or anything like that, then perhaps they'd be willing to pay that money in order to secure the other spouse. Now, I recommend both of them get that policy. If one spouse were to pass away early, then that surviving spouse, of course, could just cancel their policy and save money then on that premium. So, hope this gives some things to think about. You absolutely need to account for this in your retirement plan if you're married. Now, obviously, there's a lot of different ways that you can go here, but hopefully this helps. And if you like the video, make sure that you like it, make sure that you subscribe, and I'll see you in the next one.